What's going on? And welcome to another podcast. Feels like it's been a minute since we've done one of these. And in today's podcast, we're going to be going through Marcy's plan. And I know over the past few weeks, we've kind of said that we were going to like communicate that and like we didn't. So, firstly, apologies for that. But, the boys obviously stick to their word. There's been some changes here and there. I'll obviously let Marcy jump into that. This isn't too much around like, status of the challenge and all of that. Like if you want to see that in real time, check out our weekly reviews, check out our back testing sessions. We give more than enough detail on that. Like this session is for Marcy to go in detail around what his plan is for this 100K challenge. And I think if I'm not mistaken, updated with September's data. So
Yes.
yeah, I think without wasting any time, my G,
Yeah,
floor's
bro.
yours, bro.
Shout out, Sam. Shout out, shout out. As Sam mentioned, firstly, apologies from the boys just for not dropping when we were supposed to drop, but we're here now and let's go. So, as you guys know from obviously just from watching the reviews and watching like how we break down trades, there's always sort of a directional bias that I take when I'm entering my trades. But before we get to that, so my approach is broken down into three steps essentially, right? Step number one is getting your directional bias. Step number two is getting basically evidence collection, which usually happens on the 15 minute. And then step number three is what happens with what I call entry confirmation on the 1 minute time frame. With that being said, let's jump straight into step number one, which is your directional bias. So there's three types of directional bias. Basically, when the previous daily candle on pound yen and the previous 4H candle on pound yen matches, essentially if they're both bullish, you have your first directional bias. If they're both bearish, you have your first directional bias looking for the next 4H candle to basically continue in that direction. That's
Mm.
directional bias number one, basically. So the previous daily candle and the previous 4H candle basically in alignment, and then you're looking for the next 4H candle to essentially continue in that direction, right? Then the step or directional bias number two would be something that I call 4H correlation. So 4H correlation is basically I have six different pairs that essentially speaks to the sentiment in the market. And the pairs basically are, since I'm trading pound yen, the pairs are GJ, GU, which basically speaks to the sentiment in pound, whether it's strong or weak, what is the feel in the market, and then for the JPY pairs, it would be EJ, UJ, CJ, and AJ. And this is basically done to establish, as I mentioned, the sentiment in the market. So if pound yen and pound USD, both 4H candles are bullish, that sentiment then shows us that there is a lot of bullish bias behind the pound. And then alternatively, if you see EJ, UJ, CJ, and AJ have a bullish candle, essentially what you have is a weak yen because you can see it across multiple currencies and across multiple markets. So what that basically means is that there's a weakness in yen or in the Japanese market, and that's the sentiment going into the next session. So if like you have five out of those six pairs aligning on the 4H time frame, then you can anticipate that the next 4H candle on on GJ will potentially push in that direction, right? So that's the step number two. Step number three is when both step number one and step number two align, meaning you have the daily and the 4H candle, let's say for instance bullish, then five out of the six currency pairs that I mentioned on my correlation list are also bullish. So now you have a stronger, essentially you have market structure and you have the feel and sentiment of the market aligning, and you can anticipate that the next 4H candle is going to push bullish. Now, why do I only look at what the next 4H candle is going to do? Because essentially one session is 16 15-minute candles basically. London session from pre-London to London open to an hour after London open falls in the 7 o'clock to 11 o'clock candle basically, right? And what you will see is that is one 4H candle. And if you can determine the direction and where price is going to potentially push to, or the disbursement of price in that 4H candle, is more likely than not that you'll be able to take a trade in the right direction. Now, whether your entry and your stop loss is in the right place, it doesn't really matter. That's all up to you. To me, it's just about determining, using these three options of my directional bias, determining where the next 4H candle can go. So then you can take advantage, as I mentioned, going into step two, what the 15-minute 16 15-minute candles make up a 4H candle. So if you can determine the direction of where the 4H is going to next, you can now determine where you could potentially place a trade. And so it's that simple for me, Sam. You know that, like, I've done a pretty in-depth, and I know the people also know that I've done a pretty in-depth breakdown of what could potentially happen over a year and 9 months now, including last month's data, right? And what I know is that each directional bias performs slightly differently. With that being said, for each week I've broken it down accordingly, and then also for each day I've broken it down accordingly. Now, just in general, if I'm looking at overall what happens, the daily and the 4H has a 68% determination rate for the next 4H candle. The 4H correlation has a 67% determination rate for the next 4H candle, and then the daily and the 4H plus 4H correlation has a 71% determination rate for the next 4H candle. That's just over a year and 9 months of the daily and the 4H does this. What does the next 4H candle do, essentially? And if that happens, you have a 68% chance of, if those two agree on certain days, that the next 4H candle is going to be bullish, for instance. And then similarly with 4H correlation and with the daily and 4H plus 4H correlation, right? So with that being said, I've used this information that I've basically done research on the market, and I've pretty much put it together for a guide so that I know which weeks perform the best, which days perform the best. And essentially what I've noticed is I've broken my month up into 5 weeks, because week number one, more likely than not, runs like from midweek. Let's say, for instance, like this month, week 5 of last month ran till Tuesday, and then week 1 ran till Friday. So week 1 is usually like a half week thing, usually. So week 1 generally has a 69% determination rate or success rate for 4H candles. And that's just across everything. I'm just giving you guys across the board figures, right? So 69% potential win rate for week number 1. Week number 2 has a 74% potential like win rate, meaning the next 4H candle is going to go in our direction, just to clear that up. Week number 2 has a 74% win rate. This is including September. Week number 3 has a 62% potential win rate. Week number 4 has a 75% potential win rate. And then week number 5 has a 62% potential win rate. The importance of this is just to understand that certain weeks are better than other weeks, and understanding that my personal directional bias and the way I determine where the market's going to move in the next 4-hour candle, which I'm going to be trading, is better. It performs better in certain weeks, meaning like I can understand where I need to basically be a bit more focused, and also where I need to essentially like open up my portfolio a bit more, obviously within the bounds of my risk management rules, essentially, right? So that's how I basically determine directional bias. After I have the directional bias, then now I'm going down onto the 15-minute, and I'm starting to collect evidence. And the reason why I call this my evidence collection section, or like section of my plan, is if I have directional bias, now I need evidence to show me that price action is actually going to move in that direction, right? So for me, basically what I do is I'll plot two levels on the 15-minute time frame, which is basically your structural high and your structural low. So a higher high and a higher low, or if we're in a bearish trend, you're going to plot your lower low, and your lower high on the 15-minute, right? And both
Sure.
those levels are your tradable levels essentially. So your lower
And
high
just
will be what I call, pardon?
sorry, bro. Just a quick one, just for clarity, for maybe those who aren't as like technically inclined. So do you define your high highs, higher lows by full body closes above the previous? So,
Yes.
for example, high above the previous high, or do wicks
Yes.
kind of constitute that
No, I
full
don't. I
body
don't
close?
necessarily full body close. So let's say, for instance, we formed a high in the market, then we pulled back, and now we essentially have a higher low, right?
Mm,
Well, it's not a higher low until a new higher high is made. But we go up and we test the previous high that was made, that was our recent higher high. We test it, but we don't get a full body close above that high.
mm,
That to me then is just a failed high essentially, because after that we could then potentially either go into what I'd call consolidation, or we could then just simply reverse. But to me, I need a
sure.
full body closure above that last high point of the previous push to the upside, previous impulse to the upside. Similarly
Okay.
with like my downturns.
And just sorry, a follow on from that then. So if you see a higher high, higher low, a failed higher high, so wick, and then essentially a break of structure below, full body close below the previous higher low, which wasn't fully established, do you take that as a now break of structure? But I know you, and you're saying now you look for obviously that continuation, but does that contribute to you saying now, okay, structure shifting, or structure has shifted and now you almost in a bearish trend?
Uh, well, firstly, let's say for instance I'm looking for buys from a higher directional bias, right?
Yeah.
I'm looking, in this instance we're talking about higher highs, higher lows. If price action pushes up into the high, we fail to make a new high, which essentially now we just wicked up, we broke up, wicked for a bit, but then we didn't close above. We then pushed to the
Mm,
downside, right? If price action makes and breaks the anticipated higher low, which basically
mm,
means it's not the actual higher low, it was the anticipated higher low, right?
mm,
That will show me signs of weakness now. It doesn't necessarily mean that price action has actually broken structure, because to me, I need a defined higher high to mean that that's the new higher low. You know what I
mm.
mean? So, in order for price action to actually break structure, I would need it to break the previous higher low that made the higher high that was tested essentially.
Yeah. Okay.
But
Sure.
I wouldn't be entering sells in that session because my directional bias is buys.
Sure. Sure.
So if price action breaks structure to the downside in my session and I'm looking for buys, I'm just not entering a trade, basically. Like I don't. So within the 4H like trading session, so if I have previous 4H and I have like bullish bias from the previous like daily candle on 4H, in that 4H candle that I'm trading, I'm only looking for buys. So if price action essentially breaks structure to the downside, I'm out until the next session, basically,
Okay.
until
Okay.
the 4H candle closes, and then I'll see what happens. If I have potentially 4H correlation, now I can then go ahead and look for sells below lower lows or pull back into lower highs, basically.
Got you.
Yeah.
Got you.
So
That's clear.
I hope that kind of cleared up like the way I look at structure.
Mm,
So with that being said, I use those two levels in the market when I'm basically looking at the market. Just saying, if we get in a break above a higher high, then I'm going to anticipate that with volume times such as London Open, uh, such as New York Open, or pre London and pre New York, that there's going to be a continuation of those impulse moves, basically. Just note that, and you guys will see that when we get to the risk management section, this like the fact that the market is changing slightly a bit and the impulsive moves are not necessarily like working as much. I've dropped my risk management to about 0.15 to 0.25% on the breakout rate. So when it breaks a higher high or breaks a lower low, I'm taking a significantly lower risk until I can see that price action is actually impulsively moving to the upside again, and market
Mm.
conditions are shifting for those impulsive breaks, right? What I've noticed over the past month and a half now is that my second option of evidence collection, or my second level, which would be my lower highs or my higher lows, has been playing out way more. So what that basically means is that price action has formed a high, a higher low, and then a higher high. And now within my session, when I'm looking for buys within my session, price action essentially comes all the way down back into that deep pullback area, point of interest, if you will, 15-minute order block, whatever you want to call it, really. I just call it my higher low, my double bottom, double top area. But price action will come all the way into that area and get a reaction or from that area. That's just what I've been noticing over this time. And that's my
Mm.
second level that I essentially trade out of Sam. Now, with that being said, as I mentioned, on the 15-minute time frame, my evidence basically is those two levels and a candle on the 15-minute in my direction, basically. So for if I'm looking for buys, I need a break out of the high and a close above that high. Then I can
Okay.
anticipate that it's going to continue. If I'm looking for a buy out of my higher low or my point of interest, I need a candle closure in my direction. I'm not taking a buy until I have a bullish 15-minute candle out of that area, essentially
Sure.
showing that we are inspecting that area. Now there is more things that I will go into once we get into the entry criteria, but that's essentially what I'm looking for. I have my two levels plot, and once we bounce out of the higher low or we break out of the higher high, that essentially shows me the evidence that my bias is correct for the day, right?
Mm.
So we have our directional bias. Let's say, for instance, we have daily and the 4H. We now have price action confirming on the 15-minute that we are pushing bullish, right? What you're now going to do is essentially you're going onto the 1 minute time frame to find what your entry confirmation is. So on the 1 minute time frame, you're going to confirm that the 1 minute structure on pound yen is already trending in the direction. So for breakouts, basically, usually when price action actually breaks out of a high, like a higher high, the
Mm.
nature of the 1 minute, because the 15-minute is pushing bullish, the nature of the 1 minute is that it's trending already, right? That's
Mm.
just the nature of what happens. There's 15 1 minute candles in one 15-minute candle. So that 15 1 minute candles can form a trend to the upside with a higher low, a higher high, a higher low, and a higher high,
Mm.
and then it closed bullish and we're breaking above. And now you can then start anticipating that price action is essentially going to continue pushing to the upside. Now, when you get the breakout of a higher high on the 15-minute, you essentially going to be looking for the same thing on the 1 minute time frame when we trade in breakouts, right? You're going to be looking for a pullback on the 1 minute time frame, which usually happens at the end of the 15-minute candle when the 15-minute candle forms this wick, right? That's usually a pullback on the 1 minute time frame or correction on the 1 minute time frame. And you'll have your highest point, which is your wick, on the 15-minute time frame, your highest point, which is your higher
Mm.
high on the 1 minute. You'll be anticipating the pullback, and then you'll place your buy stop above that higher high on the 1 minute time frame. Your
Okay.
stop loss essentially will go below the higher low on the 1 minute time frame. And then
Okay.
you just anticipate that price action will continue once it breaks a high on the 1 minute time frame, basically.
I get you.
You Yeah.
Yeah.
So essentially, yeah. So that's basically it, right? So and then it's the same thing, but inverse for sells. If you're gonna find candle breaking below, go on to the 1 minute. You're gonna be looking at market structure. Now, if price action just simply continues, like, and there's no pullback, you're not entering, because that ultimately means that now you're entering in an impulsive move, and everybody tells you don't enter on an impulsive move, because what's going to happen sooner or later is that there's going to be a correction. And are you like willing to sit through all that throwdown? To me, that doesn't make
Mm.
sense. So rather wait for the pullback first or the correction first before the impulse, and then you get in on that impulse and anticipate that when the 15 minutes starts flipping bullish, that it's going to continue bullish and continue pushing to the upside, right? Now, the difference between like that specific entry, which is basically my breakout entry, and the double top entry or double bottom entry is that when you trading out of a point of interest or a double bottom, usually this constitutes of multiple 15-minute bearish candles into the point of interest area, right? Which will essentially form a downtrend on the 1 minute time frame.
Okay.
So although we bullish on the 15-minute time frame into that higher low, we have a downtrend on the 1 minute time frame because we would have broken 1 minute structure long ago and we're forming lower highs, lower lows into that
Yeah.
area. Now, the first step for obviously once you have your levels on the 15 minute, the first step for the double top and double bottom entry is to have the break of 1 minute structure first. And as I mentioned, my break of structure is not constituted by a wick above the previous lower high. It needs to be a body close above the previous lower high. In this case, we're looking at buys. So obviously the 1 minute
Sure.
time frame is pushing to the downside, forming lower lows, lower highs, lower lows, lower highs. You anticipate that once we get into that 15-minute area and we bounce out of it, you anticipating the break of the previous 1 minute lower high. In
Yeah.
order to know that it's a break, you need a bodily close above that area, right?
Yeah.
Once the 1 minute time frame close, you will now go onto the 15-minute and monitor that specific candle if it's in a close bullish or not.
Cool. And just for
So you need
clarity, and I'm sorry if I maybe missed it, but how you identify that 15-minute area?
essentially a higher low or a lower high that left a bit of imbalance. Basically, I don't necessarily count the imbalance too much, but like that left a bit of imbalance, showing that there was intent in the upside push, basically. So there was a lot of momentum to the upside, and that then constitutes a double top or double bottom area, and it has to be your last known lower high, essentially,
Sure.
or a
And is
higher
it
low. So
imbalance
basically,
at the higher low on the minute 15, but imbalance on the 1 minute
yes,
at
no,
that
minute
higher
15.
low on the 15
Minute
minute
15.
still? Okay.
Yes.
Okay.
So so
I
basically
get you.
you're plotting your levels on the 15-minute, your highest high that's going to constitute your breakout area, and then your higher low that's going to constitute your double top, double bottom area, essentially, or your point of interest, right? That
Sure.
double bottom needs to have a bit of imbalance in it just to say, okay, no, we need to kind of mitigate these orders here. And then once price action does mitigate those orders in that 15-minute level, you first look for your 1 minute break of structure, basically.
Yeah.
So you just need a clean push to the upside, a not very impulsive, but an impulsive push to the upside. And then you will then basically be looking for that when you get on the 1 minute time frame. Now, if there's no impulsive push to the upside, then I'm personally not going to take a double top, double bottom area. Really, it
Sure.
needs that impulsive nature to the upside. So then, when it does come back, I know there's a high chance now that there's going to be a reaction out of it, right? So once we do get into that area on the 1 minute, we can anticipate the break of structure back to the upside. So shifting the lower high, we have the break of structure. Once we have the break of structure, we move back to the 15-minute now to wait for that 15-minute to close bullish. We're not just going to enter all from the fact that the 1 minute shifted structure, right? Because usually what would happen is the 1 minute shift structure, it usually breaks the previous 15-minute candle's high, right? But then sometimes what would happen is that it will just continue to the downside after that. So you have your break of structure on the 1 minute. Now you have a 15-minute bullish close. What do you do now? You essentially going to be looking at 1 minute structure now and placing your buy stop above that area that made its new high that broke the lower high, essentially. Do you
Sure.
see that, Sam? So we obviously broke structure, right? We there was a boss that broke structure. We formed a high. We then pulled back and the 15-minute closed bullish, but like with a bit of a wick. You were anticipating that now when the 15-minute forms, basically when it breaks that high that is now formed, that it's just going to continue to the upside.
Okay.
And usually what that would mean on the 15-minute is that like a morning star is essentially formed. So usually you'll have like a couple 15-minute doji candles in those areas. Then you'll have a 15-minute bullish candle. And then when you enter after that 15-minute bullish candle, because usually that 15-minute bullish candle breaks 1 minute structure, you'll have this almost like morning star pattern. And you'll anticipate that it's just going to continue to the upside.
Okay.
Yeah.
See.
So that's pretty much the entries. It's really simple, but I do find that like waiting for these confirmations is important, because the minute you don't wait for the confirmation, you'll start to see that you pretty much lose really quickly. Like, because your stop loss is right below where structure is gonna break, and if you don't necessarily wait, then you'll pretty much just catch an L. Because sometimes the
Sure.
15-minute will close doji bullish, but the 1 minute structure hasn't broken. So now what could happen is that the 1 minute structure could go into a 1 minute point of interest, respect that like area, and then basically break to the downside.
Continue
And
to
now
the
you've seen a,
downside.
you know
Yeah.
what I mean? Now you've seen a shift of 15-minute structure, and now you're in that trade and you're catching an L because you didn't wait
Yeah.
for the 1 minute structure to essentially show you that, okay, we basically moving now back bullish out of a key level in the market. So
And
yes, high
that
time frame
exact
key
thing
level.
there. Sorry.
Yeah.
Continue.
No, you
No, I
can
was just gonna
go
say
ahead.
that that's probably been like one of the biggest like tweaks in like my plan. And I remember even saying, "Hey, shout out to you," because it's something I was thinking about before, because I only used to look for that minute 15 reversal candle. But then when you obviously shared your plan initially and you had that extra layer of confirmation on, what I consider your micro time frames, which is for me your 1 minute
Yeah.
or your 5 minutes and 15 minute technically. It's just such a game changer. Either the 1 minute market structure shift, or I also look for the 5 minute sort of key
Hmm.
indicator area invalidation. So a shift of structure on the 5 minute, or like a fair value gap being invalidated. But just something to say that, look, okay, yes, the 15 minutes is doing this, but it's actually doing that because the lower time frame has started, and it's almost like a chain reaction in that sense, because you do get
Yeah.
those 15-minute candles that are reversal or have those reversal characteristics, but it's really just a 1 minute pullback into its POI, and then
Exactly.
it continues lower. So that's if there's a nugget that Oaks take away from this, it's that those micro time frames are like mad powerful for just that extra layer of
Yeah.
confirmation before you jump into a trade.
Exactly.
Yeah.
Exactly. Because sometimes, as I mentioned, even if you're trading like the 4H as your point of interest or whatever your key levels, right? And you're just looking at the 4H, and all of a sudden you have, let's say, for instance, a couple doji candles on the 4H. Then you have a mini, what looks like a momentum candle with like a very big bullish candle, like not very big, but like body compared to wicks, right? Now you're going to anticipate, oh, that this thing's going to continue. But in really, what's just going to happen is that it's going to go into a previous 1H lower high, and then now next thing you know, because you didn't wait for like lower time frame breaks of structure, it goes into previous 1H lower high, and then it just continues. And now you're stuck in a trade that either you're going to lose, or like now you're
Yeah.
stuck with, if you're not using risk management, you move in your SL thinking, this thing's gonna go up, all them newbie things that happens, bro. So I think out of a key level, it's very important to see like whatever time frame you're trading on, to see lower time frame shifts of structure out of that first, to then start anticipating that price action will continue to the upside. So that's essentially like my approach to the market. Those 3 steps,
Clean.
basically directional bias, evidence collection on the 15-minute, and then entry on the 1 minute, right? Thereafter, what are my trading sessions? My trading sessions is basically from 7:30 a.m. to 11 a.m. when there's no daylight savings, and then with daylight savings from 8:30 a.m. to 12 a.m. This is South African Standard Time, guys. And then 11:30 a.m. to 3 p.m. with no daylight savings, and then with daylight savings 12:30 to 4 p.m. Essentially, just trading two 4H candles, anticipating the direction of those 4H candles, and taking advantage of that direction, right? And then non-tradable sessions for me is if there is significant red fold in news for pound yen. So whenever, like today, there was significant red fold in news, or no, yesterday there was significant red fold in news for pound. I didn't trade that session. Like whenever there's a red fold in news, such as CPI, GDP, what I've noticed is that those big movements usually takes me out, or I make a big buck, but then it's like, what's the point of being in the trade? Like when you're really just gambling. I don't have too much knowledge
Mm.
on what's going to potentially happen with with GDP, for instance. Like I can see
Mm.
the numbers, what the forecast and what the previous thing is, and then oh no, the forecast is bullish, but then now I'm in a buy, and because I'm usually in a trade around news times, like it's not really good. You know what I mean? You're gonna catch that
Yeah.
high volatility in a time, now you enter in, and then boom, all of a sudden spread takes you out. Even if you're in a good trade, spread takes you out because spread just increased to fucking 20 pips, 30. Like you don't know what's gonna happen. It's just very
Sure.
volatile, and like you don't know the conditions of the market. So I avoid those trading times. And also for people who's doing challenges, now they are obviously like at FTMO, the challenge that I did, I can trade news, I can trade over weekends, I can hold trades because of the like taking the swing account. But
Okay.
like
Yeah.
most prop firms allow you to trade through news, but like I wouldn't advise it. Just protect your capital, protect like your account. So that's
Mm.
one of the non-trading sessions that I have. And then what I've mentioned here is when observing a 15-minute breakout that closes without or no wick. So without the wick or very little wick, I need to exercise a bit of caution. And that simply goes back to what I was explaining to you earlier, Sam, is that when a 15-minute closes with little to no wick, what that essentially means is that the 1 minute is still in an impulsive phase. It hasn't corrected as yet. And essentially what you're doing is you entering on an impulsive phase without no correction. The
Mm.
chances of you getting taken out is higher because a correction is bound to happen. That's just the way the market moves. It moves
Sure.
in impulses and corrections. So that's why I don't enter when there's a breakout or even out to the point of interest. If there's like if it's a bullish engulfing candle on the 15-minute and there's no wick, what I'll do is essentially I'll wait for a pullback first, forming the 15-minute wick to the downside, and then I'll because then now we form the correction on the 1 minute time frame, right? When we form
Yeah.
that 15-minute wick to the downside, then I'll start looking for entries to the upside.
Yeah.
Uh, and then do not obviously I can't trade the first 30 minutes of the 4H candle because that's usually forms a correction on the 4H. So basically the
Mm.
wick of the candle, I can't trade that because that's what happens 80% of the time. And then this is something very important for breakout traders. I don't think this has happened too often. It's just that breakout trades hasn't been working regardless of whether the 15-minute is trending or not.
Mm.
However, when the previous session is in a range, what defines the range? To me, a range is defined by when price action creates a high and pushes
Mm.
into that high. And like, let's say we're in an uptrend, price action now created a higher high, right? We
Mm.
then pulled back. In trending conditions, we should, in theory, break that high after the pullback, right?
Mm.
However, if we go and push up into that high and we fail to break that high, and then now we back down, that to me now is a range, right? So when the
Yeah.
previous session is ranging, let's call it Asian range, right? Let's call it Asian range. When the previous session is ranging and you're taking a breakout trade, more often than not, what's going to happen is that price action is in a breakout and then break back inside that range or consolidation area. And the
Yeah.
reason behind this is, personally to me, I've just noticed it. I'm not going to go into the
Mm.
ICT things. I'm not going to say shit about liquidity and shit,
Easy
right?
things.
But
Easy.
just know that when price action forms a range, as I mentioned, like the way I defined the range was what I said. When price action breaks out of that range, if you're a breakout trader, my plan says don't take that immediate breakout, just because more likely than not, the next candle or the following candle is going to break back into that range. And that
Yeah.
to me is, I don't want to say manipulation. It's just like, bro, it happens,
Mm.
right? It's just something that I've seen before. It happens,
Yeah.
right? Now, where do I essentially take that breakout trade? I will wait for price action to break out of the range. Then I'll wait for price action to pull back, whether it breaks into the range or breaks like previous structure that formed like the low of the range, right? If it does that and it breaks that high that it formed outside the range again, I will start anticipating buys,
Mm.
basically, right? If it breaks out and breaks back in and it just continues with a lot of bearish momentum, I know that personally that thing's gonna break the low and then the next session is gonna be sell-offs. Just because
Sure.
that's what happens with Asian ranges, right? You fuck it. You get a liquidity grab to the upside, you then push to the downside, you grab liquidity again, and then you'll mitigate orders and then you push to the downside. That's
Yeah.
usually what happens. So essentially, what you're doing is you're protecting capital when you don't trade that immediate breakout to the upside after a range in the market, right? And that's
Sure.
on the 15-minute time frame. So don't trade immediate breakouts out of ranges. And yeah, and I've noticed this even if price action on pound yen ranges throughout London, then even in New York, that same thing will happen. And that's why I'm not just saying Asian session range. I'm saying like previous session range, because that
Sure.
same thing will happen where like we'll grab liquidity to the upside, shift structure to the downside, and then pull back and continue bearish essentially. And if we
Mm.
were to continue bullish, we'll basically like break back into the range, just collecting some stops, basically triggering buy stops, and also taking all of those stop losses above that area in the market, because we failed to break above that area for a long time. Now we're
Mm.
breaking above, breaking back inside. If we are to continue to the upside, we'll break that new high that was formed outside of the range essentially, and that will be a
Yeah.
confirmation as a breakout trader to continue. Then I
Gotcha.
go into my goals. Obviously my goals has changed since the last plan that you saw, Sam. This
Mm.
goal is mainly just to, within this last quarter, make a withdrawal from the 10K that I've passed. Like, make a
Let's
withdrawal,
go.
hopefully enough to purchase another 100K going into the start of next year.
Yeah.
Possibly multiple withdrawals, just like holding it in the business account, just to be able to purchase that 100K account again and be able
Mm.
to say, okay, no, I've got my money back. I went through all three stages and I went through
Mm.
everything, and we pretty much made it now. And we like, I think over 3 months, like consistent, and like you've done whatever you needed to do. So that's my main goal with this particular plan. Uh, then my plan goes into what pairs will I trade? Pound yen, as you guys know, and
Mm.
then the correlation pairs that I mentioned. The three time frames that I'll trade is the daily and the 4H for directional buyers, 15-minute
Mm.
for evidence collection, and 1 minute for confirmation entries. Then I just go into like pictures of basically just reinforcing what the trade should look like on a day-to-day basis.
Sure.
And then what I did, the difference, Sam, between this plan and the last plan is my risk management.
Okay.
My risk management is basically one line: 0.2, 0.15 to 0.25% for breakouts until I get to an average of like 60% win rate, and then 0.5% for double tops and double bottoms. And the only reason why I'm doing this is so that I can obviously get out of the slump that I was in with like failing the 100K,
Mm.
gain the confidence, and then once I gain the confidence and just making my first withdrawal and getting my fucking money back, bro. Like, I don't
Mm.
care if I withdraw 1% to get my money back. I just want my money
Sure.
back, bro. Just to
Yeah.
make sure that, like, hey, bro, like now
Break
I'm
even.
trading with free money, essentially. You know what I mean? I'm trading
Yeah.
with free money, and like now we can potentially like go back to 1%. But I think for now, that's gonna be my plan. Just trying to like get out of the slump. I've left my aggressive and my conservative risk management on my plan, but that's just for challenges. My live, like when I'm live, I have a completely different approach, and that's just to basically stay in the game as long as possible and hold on to the account as long as possible while making small and continuous gains all along.
Yeah.
Basically, like I just like if I can make a 3% at 0.5, that's a 1.5% on 100K account, that's like $1,500. I'm fine with
Mm.
that, you know what I mean? But the whole point is like not to pass the challenge, pass the verification, and then give the account back with all the
Mm.
excitement and everything. It's just to make that first withdrawal, see it in my bank account, and then be able to say, okay, it's done now. Like
Mm.
everything, like you've done the whole process. Now you can like start to look at like everything and then like acclimatize to 1%, because at the same time, like 1% is just only 10 trades of 10,000 or 10 trades
Yeah.
of 1,000, which is still very little compared to
It's
like
not
what it
a
would have been
whole
on
lot.
your own
Yeah.
account. You know what I mean? On
Yeah.
your own account, if you're risking 1%, you have 100 trades. So yeah.
Literally. It's just
Uh
different when you have that parameter.
exactly. So just keeping that in mind. And then the difference between this plan and the last plan is that I completely removed the trade management just because I found I hardly used it. So I just scrapped that.
Sure.
And like none of my trades ran into the next session, uh basically, unless it was a double top or double bottom entry. And like if it is a double top or double bottom entry, the plan and the risk management and trade management was always just let the whole thing run, basically. Because if
Y-
it's running
Yeah.
into the next session, more likely than not, it's already at break even, and you just let it run.
Yeah.
You know what I mean? So
I get you.
yeah, that's pretty much. And then I go into a bit of what to do when I lose. So basically, what to do when I lose, just a quick run through is do not take a trade immediately. Wait for the next 4H to close, and then I can trade the next 4H. Ask myself why I lost, what did I miss like within the trade, and then also just like how could I have optimized my entry and optimized like myself, like was my
Mm.
routine together, did I follow everything? So those are the
Yeah.
questions that I ask myself when I lost. When I do win, I ask myself, how can I do this again?
Yeah.
What time did it happen around? Like is there, obviously this goes into like also my 20 trade review, like what times did it happen, when are my best times to trade, and then what can I do better in the trade or before the trade or after the trade to make the whole trading process better, basically. Like
Yeah.
those are just some of the questions that I ask myself with regards to that. Then I have my pre-market and post-market routines. I don't think I'll necessarily run through that. And then also just to give you guys a bit of an overview, the tools that I use for my trades. And I'm just mentioning this because in case you guys don't actually know how to formulate the trading plan, uh, these are like just key headings that I use just to know that when I do get to the charts in the morning, what I need to do. Like I know I need to
Mm.
go to my post, like basically my pre market routine, make sure that I've ticked those things off. Then I go to my tools that I use for my trading, make sure that I have them all open and ready to use throughout the
Mm.
trading session. And then lastly, like I have my review process that I have, discipline and mindset notes, and then my trading commandments, which are basically just 10 commandments that I have that I need to do every single day with my trading. So yeah, Sam, that's basically the plan in a nutshell, bro. And like trying to run through it and just trying to give everybody obviously just an understanding of the approach to
Mm.
the market that I have. And yeah, bro.
Nah, that's clean. That's clean, bro. Shout out. I think it helps me understand also like your plan and like thought process a bit, and like obviously because we bounce things off each other, and
Hmm.
like whether we know it or not, I think our plans both like influence each other's plans like respectively, like just like the way we process
Yeah.
things like with structure and whatnot. So I think for anyone who's either starting the process of building the plan, has developed a plan, this kind of like detailed breakthrough is like really beneficial for anyone to either guide them in what they're doing, or to make them realize that shit, like that's something that I don't have in my plan. Like, what do I do when I take a loss? What do I do when I take a win? Like a different element of the plan that you kind of can now add to yours. So I think it caters to like a wide variety of
Yeah.
traders. And I think in that, and then there's something I picked up on when you were speaking about, like, obviously what you go through when you lose, like when you win, like that's really good to like keep you just aware of like how was your decision making process like in the moment, and really just to like determine whether you followed the plan at the end of the day to like the best
Exactly.
that you could. And I think for especially like newer traders, and I think this was like something that I am still just kind of like getting used to, is like you can do all the right things and the trade doesn't work out. Like
Yeah.
that's just part of having a plan. Like it's not going to work 100%. But it's always good to make sure that, okay, when in that, I kind of followed what I needed to. But even when you do, there's like things that you pick up that you maybe could have done better next time, whether it's, you know, something that is not part of your plan. It kind of informs next time you review like your plan. I should consider that thing that, you know, I picked up on that one trade that, you know, played out for 2R, but it could have been like a 6R, whatever, because there was a management tweak or whatever, or like I could have entered earlier, something like that. So that was, I think that's something I don't actually have in my plan at the moment. In terms of like when I take a loss, like what do I do? When I take a win, what do I do? Like it's, I just kind of journal it different, like in my daily recap that kind of covers that. It's more like a what did I do well today? Like what didn't I do well today? And it speaks to like my entries that I took and like my forecasting. But I think especially like from an outcome perspective, it's a really, really good twist, bro.
Yeah.
So nah, shout out to you, bro. Shout out for yeah, just the detail and the value. I'm not sure if you have any just closing words for us just to take us home, bro.
Before we go, I think one thing that I learned from Sam that I didn't have in my plan before and that I implemented now that I forgot to mention was adding an element of error and trying to cap that human error too. So we measure, generally the way we measure our trades is over a 20 trade sample size before we do a review, right?
Mm,
And trying to cap that at 10%, for instance, because you're bound at some point to make a human error because you
sure.
are human. Might be an emotional day, might be that you're tired, might be whatever the case may be. You might have like seen structure in a different way and you notice the error afterwards. The important thing is trying to cap those errors at a certain
Mm,
percentage. If you're a newbie, maybe at 20%, allowing yourself 4 trades in this, like in that sample size to like basically make a mistake. But essentially where you want to get to is like the 10% or the 5% where you
mm,
eliminating that human error and trying to trade as, like, I wouldn't say mechanical as possible, but just following your plan as
mm,
much as possible and being able to say like, oh, I took this trade according to the plan. And like, you know, that the results that you're getting back is based on every single step in your trading plan that follows
mm,
your approach. And that way your numbers are not skewed where you have too much human error and you can rely on the actual live figures that you have in your plan. So with that being said, guys, please don't forget that your unmatched perspicacity, coupled with your sheer indefatigability, makes you a feared opponent in any realm of human endeavor. From the boys at the Modern Day Trader, peace
thank you.
out, man.